Okay, right. The last set of slides are on investment property and how we recognize them. And the standard that guides us here is IAS 40. IAS 40 really guides us. And really, what is investment property? So investment property really is land or land and or buildings held, if you like, for the aim of making money, to earn rentals. Do we want to buy and sell, capital appreciation, or both, if you like, rather than for daily use in the organization. So we've kind of looked at that earlier on. IAS 16 is what guides that, the way we hold that type of asset that we for the ordinary course of the business, whereas IAS 40 deals with, if you like, property that we intend on disposing of. So typically, again, if you own the property and you're using it for your daily business, owner-occupied property is excluded from the definition of investment property. So these are properties that are not used by the company in general operations. It is possible that this could be spare property rented out to third parties or specifically bought in order to profit from a gain in value. That's the key point. He says you have situations where this building can be accounted for in two ways. If the company occupies the premises but rents out certain floors, then the part occupied will be classed as property, plant, and equipment, whereas the floors rented out will be classified as investment property. That's very, very normal. So yes, so I don't know, this bit here, PPE, IAS 16, and you're renting out this bit here. So this bit here, IAS 40. Right? Okay. Good. And typically, how do we deal with this? What does the standard tell us to do? It says, well, typically when it comes in, recognize it as cost, and you have two options. You have two options for subsequent recognition. And once you have chosen a policy, then you must stick with that policy. So either you go with a cost model, which is very much in line with the IAS 16 model, where you literally do everything we've been talking about, depreciate, if you like, as you are year on year, or a fair value model, if you like, a fair value model. So let's look at what these models are. Under the cost model, account for the asset under the IAS 16 model. But the fair value model, fair value is normally established by reference to current prices on an active market for properties in the same location and condition. So what you're doing really is that you are almost holding it at its fair current value. We'll probably see it now. I don't want to say it before time, but the key point, forgive me here, is that with the fair, they actually mentioned that with the fair value model, there is absolutely no depreciation. Think of it as stock. I mean, it is a type of stock. There is no, you never depreciate using a fair value model. You just never. Yeah, so basically, every year on year, you literally just revalue the thing, and all of it goes straight to profit and loss. All of it goes straight to profit and loss. We'll probably see that as we come on. So let's look at this question here. Celine, manufacturing entity, buys a property for $1 million on the 1st of January. Let's just do that double entry there. Actually, I just want to break it up. $1 million, and that $1 million is made up of 400 for land. So 400 for land and 600,000 for building. Right? And that's how you get the $1 million. The land element is 400,000 and the building is 600,000. And it says the building element is expected to have a useful life of 50 years. Right? So this building will have a useful life of 50 years. So they also tell us that the 31st of December, the fair value has gone up to 1.1 million. So first of all, I'm going to do the fair value model. If I'm doing the fair value model, I leave things as they are, and year on year, I literally just adjust for the revaluation. So I will have, I don't know, gain on revaluation. This is increased to, if you like, 1.1. So I literally will just add in another 100,000. And I have here 100,000. And this is in my income statement. Actually, I'll put this in my income statement, my profit or loss account. This is like I'm just trading this and I'm waiting to sell it. It's active market. You can measure reliably. The cost model, though, on the other hand, is different. The cost model is IAS 16, and the cost model says, listen, you see the 600, we need to depreciate it over 50 years. So I had 600,000, because we do not depreciate land, of course, over 50 years is equal to 12 grand. Isn't it? So I need to recognize an accumulated depreciation when using the cost model of accumulated depreciation, 12,000, depreciation, 12,000. So my net book value technically would be 400 plus 600 less the 12,000, because I'm recognizing this using, if you like, IAS 16, right? So yeah, so you're basically recognizing your accumulated depreciation as we go year on year. That's the difference between the models. You probably can imagine that most organizations will use the fair value model. I mean, we're talking about property now. Now, what we can also get, if you like, is this movement, again, from where you're transferring from your PPE, if you like, from IAS 16 to IAS 40. So you are, you're reassigning property that you once formerly used within the organization to use to sell, or to use for rentals and for sort of capital appreciation. Or you could be going the other way. But what we have to do is we have to adopt the new standard based on what it is we're dealing with. So if an asset is transferred from property, plant and equipment to investment property, and the fair value model for investment property is used, you can sort of imagine what's going on here. So the asset must first be revalued as per IAS 16, which means we create a revaluation surplus, right? Kind of like what we've been talking about. So for example, I don't know, you've had this asset sitting in your warehouse, you're using it, or you've got a building that you're using in your warehouse at 20 million, and you now want to rent it out, and you realize that its new value is 5 million. You have 5 million and you have revaluation reserve or statement of other comprehensive income, and you have the extra 5 million here sitting there because it was once, if you like, to do with your profitability or your trading. So yes, now your asset is now recognized within investment asset at 25 million, if you like. So you can derecognize this now from here, from PPE. It's no longer PPE, it's now investment asset. But that 5 million is sitting in a revaluation reserve and then later on recycled into retained earnings, isn't it? So that's what they're saying here, and then transferred into fair value. If the cost model is used for investment property, the asset is transferred into investment property at the current carrying amount. Yes, so if you decide to put it in here at 25, and then you now wish to do this, it's now investment assets. Now an investment assets is now 25, and you wish to use the cost concept, then you must depreciate as you go along, in line with the cost model with investment property. You could, like I say, with investment property, you can apply IAS 16. You can. It's unusual, but you can. But if it's transferred at the fair value model, that's wonderful, because all you do is year on year revalue the property to one second, sorry, let me just see. If the asset is transferred, if the asset is so that was that. This is a new one. If the asset is transferred from investment property to property, plant and equipment, so you've gone from investment asset to PPE, you've gone from here to here. Well, and imagine it was 20 million, and you're going to PPE. The first thing you need to do is to revalue it to fair value, and then recognize. Imagine it's you revalue to 25, so you revalue 25, and now you can have profits, of course, of 5 million. And then you derecognize it from the investment asset and put it into the PPE at 25 million. And now it becomes just what it is, depending on everything we've done, how you choose to do things within PPE. But the key point here is that with investment property, you're really able to recognize things at fair value and recognize things straight to the profit and loss account. So revalue the property first per IAS, taking the gain or loss to the statement of profit or loss, and then transfer to the property, plant and equipment at fair value. And if it's costs, you just transfer it at cost and continue to depreciate. So it's really, you're just working with what you have and just working with the models. Here's an example. Kyle purchased an investment property some years ago and carries it under the fair value model. So this is an investment property. So at the 1st of January, the property had a fair value of 12 million. So it's under investment asset right now, here of 12 million, investment asset. On the 1st of July, he decides to move into the property and use it for his own business. At this date, the asset had a fair value of 14 million. So if he's going to move it from here into PPE, the first thing he needs to do, like he's done, is to revalue it. That's 2 million. But because it's an investment asset, we can recognize the profit straight away of 2 million. So we can now derecognize this and put it in PPE, and now it's an owner-occupied used property. And it says that it has remaining useful life of 14 years, so I will depreciate over the next 14 years this PPE, because that's how we do things in PPE, isn't it? We depreciate. So every year. So what amount should be recorded in the statement of profit or loss for the 31st? Well, there we are. So you should be depreciating this over 14 years. I'm going to take a punt and say that they want a full year of depreciation in the first year, which is typically what we do, isn't it? So you should be having accumulated depreciation 1 million and depreciation 1 million as well. I mean, but otherwise, if you were being strict about it, you should only really have 500,000 of depreciation and 500,000 because it's half a year, isn't it? But the key point is you understand where we're going. Okay, great stuff. Yeah, and that, good people, is the end of that chapter. Yeah, good stuff.